Good morning and welcome to the PPHE Hotel Group Limited Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Daniel Koss, CFO. Good morning to you.
Thank you very much, Alessandro. Welcome this morning. Good morning. I'm Daniel Koss, CFO of PPHE Hotel Group. Next to me is Robert Henke, Executive Vice President, Corporate Affairs. We want to take you through a few slides today. We'll start with a short recap of PPHE and its strategy. Robert will then take over and discuss a few operational and strategic highlights of the 6 months. I will then take over and discuss the results and the current trading in the outlook, and then followed by a session for questions and answers. So if we can go to the slide 5, Alessandro. One back, sorry. There we go. Yeah. So we're a hospitality real estate group, a little bit different than others in a way that we focus on developing, owning, and operating the assets, and we have our own management platform to do so. There's a few things that set us apart in the industry. One is that our founders are still heavily involved in the company as management, but also as shareholders. They have 43% of the shares, which makes them true custodians of capital. So their entrepreneurial DNA is fully embraced by our executive team, which have an average tenure of over 10 years. Our business model will give investors an exposure and returns across the entire value chain of hospitality real estate. And in this business model, we typically grow without diluting shareholders, with a very strong capital recycling approach. And different to many hospitality REITs and real estate owners, we have our own platform to do so, which is an opportunity on its own. And our focus is always on driving equity value. And we do that by developing, redeveloping, and repositioning assets. And this approach gives us the opportunity to drive value increases compared to the acquisition price. And we have a very disciplined capital approach in doing this. And this strategy has provided us quite a strong track record, showing the strong shareholder returns even after a 2-year COVID period. So real estate really sits at the heart of our strategy. Being a fully integrated developer, owner, and operator, we like to have full control over every aspect in the value chain, and we have a very strong preference for assets with a development potential. Our portfolio is quite diversified in 2 distinct segments. One is the key city center hotels, and the second is the leisure and outdoor segment, which is focusing predominantly on Europe, which is the world's largest growth market. We have a unique approach to our capital structure, which all our growth since IPO has been self-funded, and we do that by so-called capital recycling. We have not diluted shareholders of PPHE. So we do that by raising capital on the asset basis rather than on the shareholder basis. So we raise debt on the assets, but we also raise equity on the assets by partnering with other shareholders. And what's special about our group is that we have a fully scalable management platform that has an exclusive relationship with Radisson Hotel Group. And this management platform is managing our own real estate, but it also manages the estate of our partners and of third-party asset owners. This platform has long-term management agreements, which typically provide a fee-based income, which has an upside, which is based on revenues and have an upside based on the profit of hotels. So this circle really summarizes in a nutshell how our value creation works. We try to find land sites, office blocks, tired hotels. We develop and redevelop these. We brand them. We operate them ourselves. And typically that will give us value gains that we tend to take out and recycle back into the business to do this again. Robert, over to you for a strategic update.
Thank you. We finished 2021 with Omicron, which obviously led to a slowdown in pace, bookings, and in some of our operating markets, even lockdowns, which means that when we started the year, it was very slow. So the UK was actually the first market to start gaining momentum from the middle of January, with the UK and Netherlands starting to reopen and drop the measures from March onwards. Croatia, we opened around Easter most of the properties, which is what we normally do pre-COVID. So that was the first time that we were able to do this. It's fair to say that we didn't see really any movement in those markets from sort of May onwards. So Q1 was soft. Q2, on the other hand, was very, very strong across the UK in particular, already hitting very solid performance numbers. And how did we deliver this? First of all, we had a rate-focused strategy. So we tried to really generate as much revenue as possible by driving the rate for the rooms and the products. The teams delivering the daily sort of service to our customers, we've been building up and rebuilding already in the course of 21, but continue to do so in 2022. And we benefited from some of these strategic initiatives that we initiated in 20, in 21, and even before COVID, such as the insourcing of housekeeping. So we have our own housekeeping company in the London market, which gives us a niche and an edge over our peers because we have more flexibility in allocating the team members across the properties. We've also opened our own sort of career center. So we have a walk-in hospitality career center in central London, nearly adjacent to the Victoria Hotel, where everyone can just walk in and understand and talk to us about job opportunities in the London market space. In the Netherlands and in Croatia, we provided housing to team members that would join us from other countries. So we've opened up our sort of international network to really cope with the labor pressures that are currently present in the market. I have to conclude that we are in a much better place now than where we were at the beginning of the year. We are now shifting our efforts from recruitment to training, upskilling, and productivity for the teams. We've also been driving some of the ESG initiatives, including our partnership with Zero Carbon Forum. They will help us to achieve net zero status by no later than 2050. So that's a first for our business to partner with Zero Carbon Forum. We've also committed investments in making hotels more energy efficient. That is both on the sort of the soft side where we engage our teams, our operating teams, for them to start making a change in saving energy. And at the same time, we are investing in new heating and cooling systems in some of our hotels, taking them off the gas supply in the next few months to 2 years. So that applies to Victoria London, but also our project in Rome, and also the new art hotel that we're developing in Hoxton, London, is going to be off gas, with the exception of some kitchen elements. We've also started to re-engage, obviously, and recommend some shareholder returns. So we've reinstated, or we actually started the share buyback program. At the end of June, we started buying back some of the shares in the market at a value of up to £1.7 million. And we've declared a dividend this morning of 3 pence per share, which equates to a value of 1.3 million. We have some strategic progress on the corporate side when it comes to our commercial brands that we utilize on the assets. So we'll touch on that on the next slide because it's quite extensive, but it relates to the Radisson partnership that we've enjoyed for well over 20 years. Pipeline project progress is notable. So we had 2 projects launching this year. The flagship is the Brioni development, which was a 5-star hotel in the 70s. It was a 2-star operation when we closed it down 2.5 years ago. We spent £30 million and transformed it into a premium luxury hotel. So back to its 5-star rating, and we badged this a Radisson Collection hotel. The second investment is in Arena Soja campsite, which is the 3rd campsite that we've invested in as a business. We have a number of 8. We have 8 campsites in Croatia. This is the 3rd investment for us, and we upgraded the entire to the product, repositioned it, and have introduced 75 sort of luxury mobile homes or lodges, all sea-facing in this location. We'll touch on progress on the pipeline shortly. Moving on to sort of the Radisson Agreement that we've entered into. For 20 years, we've enjoyed an exclusive license for the Park Plaza brand in Europe, Middle East, and Africa. Our objective was to leave that intact because we've seen the benefits of this arrangement. So that is still in force. It's a perpetual exclusive license to us to develop and operate Park Plaza in EMEA. But over and above, the new agreements give us a few benefits. So we've entered into agreement with Radisson on Art Hotel, which is a brand that we own, but Radisson will take a development interest. So we don't allow franchising, but Radisson will be allowed to develop, manage, and lease art hotels in markets around the world, which for us will lead to greater brand awareness, a greater footprint for the brand, more customer awareness, and ultimately fee-based income for the group. So there is a fee mechanism in place that for any art hotel that Radisson will manage or lease, we will have a share of fees collected. In addition, we've also secured favorable commercial terms to start using some of the other Radisson brands in the portfolio. So we had the first hotel where we applied this in the form of Brioni in Croatia, which was originally supposed to open as an independent hotel. We felt it was appropriate to look for some greater awareness, recognition, and brand equity, and entered into an agreement to partner with Radisson Collection, which is the best brand in the Radisson stable. So Brioni sits alongside some of Radisson's most premium products. We are also interested in pursuing other opportunities, current and in the future, with potentially other Radisson brands, if and where we see it makes sense to do so. On the management side, this is probably an under-highlighted part of our business from time to time. We are asset-heavy asset owner, but all of our assets, as well as those owned by third parties or co-owned, are also serviced by our internal team. So we have our internal management company, where we believe there is a lot of growth opportunity moving forward. And a good example is the Battersea development here in London, which we're about to open. That hotel, when it opens, will be serviced by our management company, but it's not a hotel that we own, it's third-party owned. We don't have to scale up the team. We typically employ a hotel team that runs the day-to-day operations, but all of the central and back-of-house functions are provided through the platform, including all the commercial benefits derived from the Radisson relationship, such as the reservation system, but also buying power, purchasing power for FF&E, but also for OTAs and travel agent commissions. The pipeline update is as follows. So we've completed Brioni and Stoja this year. We also had a slight or light refurbishment of the Art Hotel in Budapest. Phase 1 was completed over the course of summer, which was all the public areas and meeting spaces, and we created a wellness facility area. Phase 2 is planned for later this year, where we will renovate all of the bedrooms. Bigger projects are the Battersea development, which is at its final stages. In the last 2 months, we've announced the Signature Artist, which is a core part of our Art Hotel brand positioning. So we announced the Signature Artist, the interior designer, as well as the executive concept chef. This will be an amazing hotel when it opens, and is a management agreement for us. Our biggest investment as a real estate owner is the Art Hotel London Hoxton. We've reached the highest point of the building, and as a reminder, this is a 27-story building in the heart of Shoreditch, offering just under 350 bedrooms, as well as some extensive office space, various restaurants, bars, and wellness. We've started sealing the building, so the cladding is now in place up until floor 8, with the rest to follow in the next few months to come. We have 2 longer-term land site developments in London, one adjacent to Park Royal and one near Waterloo, adjacent to our Waterloo Hotel. These are longer-term projects, so we'll continue to refine the plans, go through planning. In one of the 2 instances, the other one has planning. So it's more of a longer-term project for us. Zagreb is more imminent. So in Zagreb, we are converting an office into a hotel. This hotel will open in the first half of next year as a premium lifestyle hotel in the city center of Zagreb. Shortly followed by Rome. This is a hotel that we acquired in November last year, kept operating as an independent. We closed it at the end of June. 1st of July, the builders went in. We have now started demolition of the interior, and we're looking to open as an art hotel in June, July next year, simultaneously with the development in Pula, which is the city center hotel that we own in that market. From an ESG perspective, I touched on some of the investments we're making. We're committing £2 million into Victoria, London to take drastic action to change the energy, heating and cooling systems in that hotel, taking it off gas as well. We are equally committed to do this in Rome, in Hoxton, and we have additional projects on the radar. And there's more detail on here, which I'll leave with you to review. Daniel will talk us through the financial performance of the first 6 months.
So on the financial performance, the 6 months have a very clear division in the first quarter and the second quarter. Obviously, I almost forgot already, but the first quarter we were pretty much shut. So in Germany and the Netherlands and in Croatia, all our hotels were shut. The UK was open, but government advice was work from home, stay at home. So a very slow business. And the second quarter really is where we saw the traction. Germany and the Netherlands needed a bit of time, so I would say around May onwards, they started to track up. The UK was much sooner because we never closed it, and that's also very visible in our results today. So I'll start off with the key property KPIs. We've reported a NAV per share of £21.88, which is slightly down from the year end. This is just purely because of the loss that we had in the first half, or really the first quarter. We do valuations annual, so external valuations are done annually in December. So also this December, we will do an annual external valuation and update the NAV. Then looking on the earnings or EPRA earnings per share, cash flow per share, we reported 1p, first time positive since the start of COVID. We're also looking at our current trading. We had as a board confidence to reinstate shareholder returns, starting with a 1.7 million buyback and now complemented with a 1.3 million dividend. 3p dividend, quite modest still, but with the cash flow progressing, we hope that our dividends will also progress upwards again. If we look at the operating KPIs, we reported the RevPAR of £68. If we compare that to 19, which is kind of the last normal year, we are at 73% of 19. If I exclude Q1, so just looking at Q2 standalone, that is at 90% of 19. And what you'll see in the current trading, which we'll tap on later, is that we are currently at 19 level RevPAR-wise. You do see that RevPAR is very strongly driven by room rates. So we reported room rates up 16% compared to 2019. In Q2, they were up 18% compared to 19, and that's across all territories. We see that trend. Occupancy, on the other hand, is still below 90. So although you see a 48% occupancy here, in Q2 it was 59%, which is still about 17% behind what we were showing in 19. But RevPAR is completely made up with the increased rates that we're seeing, but there's still some place to go on the occupancy. So total revenue increased to 113 million, in line with RevPAR actually. If we look at the EBITDA, it's 17 million. If we divide that between the two quarters, it's 5 million negative in the first quarter, and it's 22 million positive in the second quarter. So if we just translate the second quarter into EBITDA margins, we're looking at the margin of 27%. And that's versus a Q2 2019 margin of 36%. So we're still about 9% behind in margins, and there's, I would say, two reasons for this. One is obviously the Netherlands and Germany only got traction in May, so there was still 1.5 distorted months on those two territories. And secondly, it's the different demographic that we are dealing with currently in the UK. So in the UK, after Brexit, we can only recruit domestic, which we are, but we do see in the demographic a lot of younger people and a lot of people that are new to the industry in its entirety. So productivity is really something we're focused on. And over the summer months, July and August, we already saw our margins normalizing. On cash flow, we showed a positive cash flow in H1. If we look at the CapEx and funding cash flows, they mainly relate to our two projects, one completed Brioni and Hoxton. These are the biggest one in here. You'll see a debt service of £30 million, which is 26 million ongoing debt service, and 4 million is the catch-up of COVID. So basically, everything we deferred over COVID, we're catching up right now. So our cash position declined with 10 million to 126, which is still a healthy balance, I would say, with a further access to 77 million pounds of undrawn credit facilities. Going to our debt structure, obviously we're in a rising interest rate environment. Just wanted to reiterate that 86% of our debt is fixed rate debt. The other 14, the majority of that is the Hoxton development debt, which is variable rate until opening April 2026. But most of our debt is fixed rate. The average maturity of our debt still has 5 years to go. And we report a net bank debt leverage of 35%, slightly up from last year because of the development debt of Hoxton, and Hoxton is shown in cost in our books. So obviously the interest rates are increasing currently in the market, so we decided to already start forward hedging our interest rate exposure. So one forward starting we did is on the Hoxton development debt, which in April 24 turns into a normal debt for 6 years. So we've swapped and fixed the interest rate on that loan for 1.5% swap rate. And we also started entering into forward starting hedges for loans that will refinance in 2026. We started entering forward hedges for 5 years following 2026, around 1.9% swap rate. So then on outlook, we had quite strong months in July and August, both months trading above 2019 same period. July was particularly strong in the UK with double-digit RevPAR increases compared to 19. And Croatia recorded a record season in both July and August. These 2 months, I have to say, are typically leisure-driven, which is a segment we feel has been fully recovered since COVID. So the forward booking phase also looks solid. We see a growing number of corporate bookings and requests for M&E space. But September is a very important month for us to see how far that's back. So September is usually the month that leisure transitions into corporate. So the first weeks of September will be quite important for us to see how far corporate bookings are back. Then on the industry-wide inflationary pressures, they will definitely not pass us. We are particularly concerned about the energy prices that we're seeing currently, which we feel will lead into margin headwinds into 2023. It's quite difficult at this point to give an exact assessment of the impact, as we are still working on quite some substantial initiatives, some CapEx initiatives, but also just low-hanging fruit in terms of saving initiatives. And trying to buy energy on the wholesale market, but directly by energy producers like solar or wind. So there's a few initiatives that could materially impact our costs next year. So we would like to wait until the end of Q3 in October, when we will update the market again, and that's when we can assess the impact a bit more. We're looking currently, this year we're fully hedged. So this year, and we already hedged last year, so this year we won't feel the increase as much. But next year, the current prices are already trading around 500% of the hedges that we have in place this year. Obviously, besides the energy efficient measures, we are still very focused also on implementing technology and automation to further mitigate all the cost pressures that are coming at us. So from a payroll perspective, we think we should be okay. Also, a large focus on our productivity is showing to work. Like I said, over the summer months, we did saw our margins increase to normalized levels again. That was it for the presentation. I'm happy to take questions. I'll go through the questions that are submitted on the site. Let me start first with what happened to the New York development. The New York development is still on pause. Just to reiterate, we bought a site in New York actually a few months before the pandemic. We intended to build a hotel there. The pandemic caused the New York market to be very, very volatile from a real estate market perspective. I would say residential is quite strongly back at the moment, but hotels are still suffering. We've decided to pause the development until there's more clarity around the hotel real estate market. We do not intend to invest if this project it will not be valued at a higher price than what we're going to invest. So we currently paused the New York development. With the market recovering and such a discount to EPRA valuation, what do you see as the catalyst to narrowing the gap? We've consistently traded below our EPRA NAV, and you know, one of the reasons that we started providing this to the market back in 2018 was to show that our business model is very much real estate and operations, and not purely operations. What closes the gap? I mean, that's probably market dynamics on which we're not in control. We feel that the gap is too big. We feel that the NAV that we're giving to the market is quite conservative. It's a NAV based on going concern. It's not a NAV of selling assets. So we feel it's a fair reflection of what our assets are worth. How the gap will close, I don't know. That's down to market dynamics. So what balance do you see between rate and occupancy growth and initiatives to drive towards the occupancy of circa 70% pre-pandemic? Strategically, currently, we are highly focused on rate driven because there is a lot of demand out there. So strategically, we have a rate driven strategy right now. The reason also for that is that gives us kind of a cushion for the inflationary pressures that we experience currently. Obviously, part of the occupancy drop in the UK has also to do with the labor pressures that we've experienced throughout the year. I would say they are stabilizing, but still on productivity, like I said before, we still have some work to do. So driving rates versus occupancy enables us to get the same revenues in, however, with less staff. So that's pretty much where we are right now. Obviously, going further into 2023, we tend to drive the occupancy, but we like to keep and stick to the rates that we currently have. So whenever we're back, I don't know. It depends really on the market. RevPAR-wise, we aim to be back at 19. Predominantly driven by room rates currently.
Thank you for that, Daniel and Robert. I think you've addressed those questions from investors, and of course, the company will review for all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Daniel, could I just ask you for a few closing comments?
Yeah, thank you very much for your attendance today. Exciting times ahead, I would say. We all don't know what's coming at us, but it is definitely exciting times. And I really look forward to seeing you at the annuals. Thank you very much.
Thank you.
Daniel, Robert, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of PPHE Hotel Group Limited, we'd like to thank you for attending today's presentation, and good morning to you all.